Hey, welcome to the podcast, everybody. Today is Thursday, August 30th. Got one more day left in the month of August, and it's been a real snoozer, to be honest with you. And we're finally starting to get a little action, a little more volatility. And we've got these nice round numbers, as you can see from the screen. The Dow Jones hovering around 13,000, was down about 105 today, and really sold off, early in the morning. Kind of meandered up most of the day, and then the last, 10-15 minutes sold off to almost the lows of the day, right at 13,002, down 105 points. The transports, they went under 5,000, another round number, down 56 points, about 1%. Utilities continue to slide, although you're starting to see the safer staples, consumer staples, non-cyclical type companies at least start to outperform the last few days. They're not going up on an absolute level. They're still falling, but they're falling at a slower pace now than the overall market. Semiconductors down almost 2%. The Russell 2000 down 1%. Mid-caps down. Financials down, but a little better than the market. And the S&P down 0.75%, just under 1,400. So you have these levels of S&P 1,400. You have the transports at just under 5,000. The Dow Jones Industrial just around 13,000. And the NASDAQ, with maybe a bad day, could be down at a round number of 3,000. So you have all these psychological numbers in there that, for the most part, are fairly meaningless, but interesting to see some of those all lining up on these round numbers. So here's a picture of the Dow Jones, and you can see this is the opening of the day. We had this big down tick, and then, of course, went lower right around the 11 o'clock hour. And kind of meandered up, as I mentioned, and then here's that end of the day selling. Now, we do have Jackson Hole tomorrow. Actually, Jackson Hole's been going on, but Ben Bernanke is going to speak tomorrow. And the market seems to be acting as if he's going to discuss QE3 further and maybe some other options or alternatives, but he isn't actually going to pull the trigger tomorrow and might actually wait until September to do something. And I kind of feel like maybe that's going to be the case as well. And the reason I say that is you're getting these mediocre numbers that, again, show the economy very, very lethargic at best. We saw the GDP report yesterday, 1.7% for the second quarter. That's an annualized rate at 1.7%. So those that were saying recession are looking at it going, okay, we don't have that yet. And so the bulls are saying, aha, see, there's no recession. But is it strong enough to take the Fed off the table? And see, so you have this in-between scenario where it's not weak enough necessarily to cause the Fed to do something, but it isn't strong enough to really get the economy growing and back on track and get the unemployment rate down. So what to do? And I think you're seeing that the stock market is meandering around and actually just, moving sideways. We're seeing, besides today, some a range of less than 2%, really for the whole month of August. And at the same time, you're starting to see the volume really just completely dry up and continues to go down. I've got a 20-day moving average here on the screen on the bottom end, and you can see that the volume continues to drop off as we've come into the month of August. It's getting lower and lower and lower. And that's continued. So what we're really seeing is a couple of things. Number one, we have this obvious double top here that is now firmly in place, and we had this exactly what I thought. I didn't necessarily think would happen, but I thought it was a possibility I mentioned on the podcast as far as this fake out breakout. And that was the time when it broke above the old high. A little bit of buying came in. It reversed that day, finished back below it, and we've been down ever since. Not a lot. Today was the first day you've seen, 100-point down day in a while, but it's not a lot. But it is, again, an advantage to the bears so far. And at the very least, if you're looking to buy, you're saying, well, I need to wait till it comes back to this trend line. Further than that, then you start getting into the 50-day moving average, which is, starting to kind of move that way. So that could be at the 1380 level. And then obviously if things get really nasty, the 200-day moving average comes in, which would do something like this, which gets you down to maybe the 1350 level. I think at that point, if it's not a substantial, intense move down, there's going to be plenty of things that will be, pretty safe to buy. But again, as I pointed out earlier, you are starting to see some of the cyclical type names at least start to outperform. If you look at something like utilities, which I've owned for well over 2 years, and still in a very strong long-term uptrend, but certainly in August they've been an underperformer as there was that rotation back into some of the cyclical names. And now you're seeing the reverse. So it's not that utilities, for example, today outperformed. They did outperform. It's not that they went up. They just simply outperformed. You see, they were still down 0.5%, a little bit better than the market, which was down, depending on which market you looked at, somewhere between 0.75% and 1%. So there's a little bit of outperformance. But what's a little different than, let's say, the April-May time frame. Remember in April and May what was going on? Utilities were going up, right? And what was the market doing? It was heading down. The S&P was going down during that time. So now that you have the S&P going down, you're not seeing the rotation back in there. You're just seeing a relative outperformance. And so that should be a little concerning, because one of the things that I warned about, several podcasts ago, was the fact that what happens if, we know we have things like coal stocks. Let's take a look at coal, for example. You look at coal stocks here, and this is the coal ETF, and it was just in a downdraft, and then, of course, it had this short covering rally in early August. Now it's approaching new lows. So this little rally we had was, again, could have been short covering, rotation, whatever it might have been. It's failing now. But the thing to point out was that coal stocks were in a bear market, no doubt about it. And the question was it going to spread out into other areas, or was it going to be isolated just to specific sectors like cyclicals? And I think what you've seen is you are starting to see the deterioration in the market spread out just a bit. If we look at companies like Caterpillar, for example, they were heading straight down based on the fact that, growth is slowing and we are still, a recession is still a big threat. So, the stock went from 115 down to $75. Big move. Had this rally and everybody said, hey, some of the data's coming a little better. Maybe things are okay again. Was it short covering? Whatever. Who knows? But the bottom line is, look what's happened since then. Now we're heading back down. And you would expect, while this is happening, that you would have the utilities and the healthcare and things like that doing much better. And that's not happening. What's happening is these things are just going down a little less. So you're still having overall deterioration in the market. And, again, when we talk about the volume has been, continues to get worse and worse and is anemic. Now, a lack of volume isn't necessarily bullish or bearish in and of itself, but in a healthy bull market, you should see volume expanding and a demand going up, and we're not seeing that. So what I think is happening is that people obviously are waiting for more signs of stimulus or confirmation that it's not coming. And it seems like the market is beginning to price in the fact that it's not coming right now. Now, could come in, later in September. That's only, it's only a day or two away, but here we are. It could be 3 or 4 weeks from now. But that could be what the market is looking at right now, and is taking off some of what was pushed up because QE3 was imminent, based on several comments, based on rumors out of the Wall Street Journal, whatever the case. So in the very short term here, we do have a time where there's no need to do a lot of extra trading. I took some profits on energy today because energy essentially, if we look just at the oil prices, you can see they paused just at the 200-day moving average. Very convenient place. They could just be pausing and pulling back temporarily. That's certainly possible, and it wouldn't surprise me if that's the case. It's an area I still like quite a bit, but you can't deny the fact that if the economy continues to weaken and people get concerned about the economy, they're going to sell oil stocks. But it could be a dip just like this one that we're going through, and maybe it pulls back just a little bit more, and then it rallies up and up it goes. That is highly possible. But given that we're in a market that is suspect right now, and there are people on both sides of the fence, bulls and bears, I'm tending to be a little more agnostic and say, let me just kind of lighten up on things that are at a point where they could possibly roll over, and at the same time be opportunistic. There's still plenty of stocks, individual companies, that are attractive. And I think obviously on some kind of pullback, they're going to become even more attractive. I've had a lot of things on my radar that I've been watching for several weeks that are now starting to come back in just a little bit. And they're not tanking, but they're coming back into a more attractive buy area. But as far as big macro sectors are concerned, oil is one that has had an unbelievable run. Remember, oil was at $77, went almost up to 100. Obviously went up in anticipation of Hurricane Isaac, and now that wasn't a Cat 3 or 4 or 5 or even a 2, Cat 1 storm. It's coming back in a little bit. So I still like energy, and I wouldn't be opposed to owning some individual names. But as far as a group, that's where I took some profits today because it looks like it has the potential to roll over, as does oil. Last thing I'll touch on today is gold. And as you can see, it pulled back from a trading perspective, probably right where it should have. Here's the downtrend that was in effect. And, of course, we extend the line out, and it rolled over right where it, quote-unquote, should have. Now, a lot of these moving averages that I have on the screen, the 50 and the 200, frankly have been fairly meaningless. As you can see, it's just, if they've crossed over them many times. I would suspect that we probably would get some type of pullback maybe to this 155, 156 area, and then that's probably a good place for gold. I think gold's still in play, and I like it from a longer-term perspective, not necessarily a short-term trading perspective, but I think, as I've pointed out in recent articles and podcasts, it has moved sideways when you look at it from a weekly chart, and it's just been kind of consolidating, volatile, but kind of consolidating and moving sideways for really over a year now. And I think when it does that, it's assuming that it's in this bull market still, it's time to buy gold. So I still like gold here, and I'm not going to worry about these day-to-day movements. As you can see, it was kind of flat today. Really was a little all over the place, not highly volatile, but it was all over the place a little bit and pulled back just a hair. But it wouldn't surprise me to see us give up maybe $4 or $5 on the GLD, which of course is the ETF for gold. So just remember, be careful of positioning yourself too heavily one way or the other before Ben Bernanke's speech. But it looks like to me the market's starting to price in more jawboning at this particular meeting and not necessarily any action. And look, with the Dow still at 13,000, I think that's a big deal. And he is watching the stock market. Consumer confidence continues to fall, but with the stock market hovering around 13,000, people may say they're not confident, but with the Dow at 13,000, people feel a lot better than when it was at 11,000. And I think he may be keeping some bullets in the holster and saying, let me wait to see if we get what happens if we get a 15% correction in the stock market and oil prices are still up there, the economy continues to print weaker numbers, then he would probably use that bullet of QE3. And I think that is coming. I've been saying that for most of this year, that I think QE3 in some form or fashion is coming, but I'm not necessarily sure he's going to act tomorrow during his speech at Jackson Hole. Thank you guys. Appreciate it. Don't forget carleggers.com, eggerscapital.com, twitter.com/carleggers. Through a Trader's Eyes is on Facebook, so you can like us on there. Google+, Karl Eggers on there. All those different places to follow our work. And just carleggers.com. Thanks a lot. Appreciate it, and have a wonderful day.